Okay, so hello. I will begin with. I will try first to answer the question you see on the screen, and then I will move to something else, maybe some more introductory issues concerning pensions. But first, let me refer to the question. So there are two answers to the questions, which I consider wrong. First is an obvious yes, and the second is an obvious no. So let's start with the second one, because I believe most of you would answer that question in the negative way. So you believe that European pensions. I know if you hear me well, because yeah. Because the popular view, especially among young people in Poland, and I know in Europe maybe too, is that future demographic situation will be poor, and that's why the pensions will be either very small or they will be non-existent. So the pension houses, so the social security will go bankrupt, and that's a false scenario. But which and I will try to explain why. But also a strong affirmative yes is a false answer either, because in many European countries, that also to some extent this statement is applicable to Poland. The rules so the pension promises, as they are made, as they've been made and they are made, they cannot be fulfilled. So most European countries, they need a pension reform, by which I mean some way to balance expenditure and revenue of the pension system, and usually that would mean a decrease. Yeah, maybe it's harder to adjust when I don't say anything. So okay. No. So usually this reform would aim to decrease the pension spending, and so in some sense pensions are not safe. So some people were promised a higher pension than they would be able to receive. So after this introductory remarks, let's move to maybe some theory on pension systems. So I would think about pension systems. So I think a pension system can be characterized by asking four fundamental questions. And the four questions, they generate, so that you answer them yes or no, and by answering these four questions, you will have 16 combinations of possible pension systems. They are logically possible, but most of them are practically impossible. So the actual number combination is smaller. So let's start with the first question. Is the pension system compulsory or non-compulsory? That means if we are forced by the state to pay mandatory pension contribution, or if we voluntarily subscribe to some pension scheme and we can cancel it, or maybe it's not easy to cancel if we subscribe, but the decision initially is voluntary. And there are some arguments in favor of compulsory pension systems. Also there are counter arguments. I'll present them in a moment. First, let's go briefly through the other questions. The second question is whether the pension system is funded or non-funded, which usually means a pay-as-you-go system. A funded system accumulates reserves for future pensions. So your money that goes to a funded system is invested usually in financial assets, stocks and bonds, and they work for your future pension. So you accumulate a capital, and then this capital is gradually liquidated. That is where your pension comes from. So at the end of usually there is a pool. So it's not that you just consume your capital, and if the capital is the capital bucket is empty, you starve. You don't get any pension. No, you with this capital you can buy a lifetime annuity on the private market. Although there are troubles with such annuities, I'll mention them in a moment. And the pay-as-you-go system is a system common in the state pension systems, of course in Poland and in European countries, in the United States. That's a system that works without any reserves. So pensions are paid from the money received from current workers. Sometimes if a system generates a surplus, that's a rare instance, the government takes the surplus. Sometimes it even may invest the surplus, but generally these systems generate deficits, and this deficit is filled by the state budget. So the third question is whether the system is private or public. A private pension system means that the institution that operates the system is in private hands, and usually there's more than one such institution, and there is some competition among them. And the public pension system usually means that we have one state-owned institution that deals with pensions. And the fourth question is whether the pension system is based on defined benefit rule or a defined contribution. And usually, so a defined benefit means that you pay some pension contribution which is only loosely connected with the pension that you'll receive. There might be some connection, but it's very indirect. So people who are richer, so who earn more money and pay higher pension contributions, they usually have higher pension, but not in proportion with their wages. And so it has some there are some redistributionary effects built in a defined benefit scheme. And the defined contribution system is a system where you pay a contribution, in which amount of which will serve as the base of your future pension. And let's go briefly through some examples. I think there are 7 examples. So the first one, most common pay-as-you-go system, so-called the Bismarck System. That's a compulsory, non-funded. In fact, if you look at the table, you see some relationships that hold, like you cannot have a non-compulsory, unfunded pension system, because rather rational person would not subscribe without state compulsion to a non-funded system, because of its redistributionary effects, because it's risky, and only people who would expect to benefit from such system. So the benefit at the expense of the wealthy would subscribe, but wealthy would not subscribe. So in fact, these poorer people would not benefit at all. So in fact, they shouldn't have subscribed at the first place. So so that eliminates some combinations, and there are also other combinations that are eliminated. But maybe let's concentrate on the one that are left. So a Bismarck system, that's a system where you have a defined benefit. So you get some pension after exceeding some age, like today in Poland 67. Although we don't have a Bismarck system, don't understand me like that. But after exceeding a certain age, you get a pension which is loosely connected with your earnings. In fact, the civic pension proposal that is popular in the more libertarian circles in Poland is the Bismarck system. It's a form of a Bismarck system, although operating on a low scale, but still it's a defined benefit, like 1,000 zlotys per month, state-owned, because the state social security would deal with such payments and collecting contributions. It's non-funded and compulsory. The second combination that's much maybe a few more words about the Bismarck system. In most European countries, Western European countries, we have some form of the Bismarck system. So they operate on the base of defined benefit, not defined contribution. So the pension is rarely loosely connected with the amount you paid. We can have a funded compulsory state system. For example, in Norway, you have, or in rich oil countries, when the state is rich because of the oil revenues, and they spend less on pension than the amount of money the state collects, and they build a sovereign wealth fund for future pensions. So they have, they can give rather high promises of high pensions, because they can build reserves for that pensions using the funds that come from the sale of oil or gas. But that's a rather rare instance. Only you can see that in countries where some extra money can be collected by the state, not from taxes. Another another combination that is possible, but it's rather some historical example, especially in the West. In other countries, it's much more popular. Family working as a pension system. So it's non-compulsory, non-funded. You don't build reserves for elderly people. The consumption is financed from the revenue of the younger generations, and it's private. It's a defined benefit, because benefit of survival or some level of consumption is not connected with the amount of money you gave to your children. That's only loosely connected. And well, of course, that works pretty well. It's self-adjusting. If the consumption of the elder generation is too high, they must decrease consumption, and if still they cannot decrease, they might try to look their luck some outside the family. They can ask other people for money. And maybe still skip a sovereign wealth with defined contribution. You can imagine how that would look like. Let's move to the so-called first, second, and third pillars. These are the pension systems that are recommended by the World Bank and which were in certain form built in Poland in 1999. So we have a Polish first pillar, which is compulsory, non-funded, public system with a defined. Oh, sorry, that's a mistake. That should be a defined contribution, not a defined benefit, because we have a defined contribution in the Polish first pillar. So the pension is calculated, or future pension, on the basis of your contributions throughout your life. And in the second pillar, you of course have the defined contribution rule, because your money is invested in the financial markets, and the pension will be based on the amount of money collected from you, and plus the interest. But the difference is that it's private, and of course it's funded. The first pillar is not funded, but it's compulsory. Yeah, I think it's. Surely the table is wrong. If I will distribute my slides, I will correct the table, because it might be a source of confusion. So the third, no, compulsory. Compulsory is okay. Yeah, because the Polish third pillar is non-compulsory. That means voluntary saving for your pension, and of course it's funded. Okay, so maybe you want to ask some questions, because I want to be this division to be clear. We can proceed further. But so, do you understand these four fundamental features of a pension system?
Can you just say briefly what the system is in the States?
Where?
In the States.
Mostly they have. Yes. It's because I say it's the defined benefit is loosely connected with with your contribution, and this loosely can be totally unconnected, like 1,000 zloty per person, regardless how much you paid, or there might be some formula. I don't know exactly how it looks in the United States. I think it's connected, but not that much. Okay, what?
Maybe I'm going to far. Perhaps you can tell how many workers are financing one pensioner in Poland. Maybe you will tell us this later.
I think three workers per one pensioner. Yeah, but of course this proportion will grow in the future. Diminish. Okay. Okay, that's a brief history of pension systems. So we moved from a natural system, decentralized, self-correcting, that is family, to the first institutional system, which is centralized and anonymous but politics driven, the Bismarck System, when where the level of pensions is in fact decided by parliament, and there's a popular policy is to increase pensions. And of course the system works pretty well, provided that the demographics is favorable. So the next generation can meet the promises, because the number of people is greater. And it worked for in Germany for 50 years or more. And then after so-called second demographic transition, when the fertility rates started to fall dramatically, and they've fallen below the death rates. So the natural population growth became negative, and that started a bad period for non-funded pension systems, which resulted in some ideas of a reform. And this reform is, in many countries, originated a second institutional system, which is is partly decentralized and more economics than politics driven. And okay, maybe let's skip that. So what are the arguments for making a pension system compulsory? And so there are two most important arguments. So first is to eliminate short-sightedness of the people. So people usually don't think about their retirement until they retire or until they are close to retirement, and that's too late to save money for retirement. So, and that short-sightedness might generate a free-riding problem. So people who are short-sighted, they might free ride on the people who are not, and that takes the form of of course that's possible in democratic politics. So they can form a party or support a party that will give them pensions, and in fact they will be better off because they were short-sighted and they spent all their income, and they still have pensions because through political process the pension was given to them. So in fact they benefited at the expense of prudent people. So the argument goes that we should then force everyone, in fact in case of prudent people, that would not force them because they would do this anyway. So in fact we should force short-sighted people to save for their pensions with the idea to prevent them in the future from taking the money from the prudent people through political process. And this argument was endorsed by an economist, not maybe an Austrian economist, but an economist probably known to you, in the following way. A possible justification on the liberal principles for compulsory purchase of annuities is that the improvident, so imprudent, will not suffer the consequences of their own action, but will impose cost on others. We shall not, it is said, be willing to see the indigent aged suffer in dire poverty. We shall assist them by private and public charity. Hence, the man who does not provide for his old age will become a public charge. Compelling him to buy an annuity is justified not for his own good, but for the good of the rest of us. Who said that? You have a photo as a hint. Do you have any idea? I have a big trouble with recognizing faces, so I would lose in... Who?
Paul Samuelson?
No. The opposite. The opposite of Paul Samuelson.
He looks like Milton Friedman.
Great. You get fractional reserve banknote from Michał. Yeah, that, and of course, then he continues, to be honest, he continues that in fact, the proportion of people, elderly people to the rest of the population is not big enough for them to force the non-elderly to pay for them, and he said that he doesn't believe in this justification now, but in the future, when the population of elderly in the proportion to the total population will grow, the problem will might be much more severe. And in fact, we are in that historical moment now. The percentage of elderly population will increase, will double or triple in the next 30 to 50 years. Okay, so but there is another argument because for compulsory pension system, not for the one that will aim at short-sightedness and free riding, but rather at some market failures in the life insurance market. So it's not that we want to protect someone, but we want to protect the whole institution, because because of negative selection problems, lifetime insurance doesn't work. Because people who are most eager to buy lifetime insurance are the most healthy, and the rates that are charged by the insurance companies are very high, and it discourages those who are not that healthy, and you get a classic negative selection like market for lemons. And it was one of the markets that did not develop any successful counter forces that would stop this negative selection problem. Because usually, if you find that these negative selection problems are only theoretical, in practice they don't happen because spontaneous order prevents them from happening. And in the case of lifetime annuities, as far as I know, even the spontaneous order works rather poorly. So you still have very small lifetime pension and you pay a lot of money for it. So the market works badly, and that's why we should. So the argument goes, make this system, make everyone participate in the system. Of course, that argument can be beaten if you find a way to get rid of the negative selection problem. But there are some counter-arguments against compulsory pension systems. So the first one is that people, that's not an economic argument, but rather an ethical argument, that here we have a big redistribution in the random direction. So in fact, you make people who have total lifetime utility smaller because of the fact that they live shorter lives, finance consumption of those who live longer. So their total lifetime utility is bigger only because of the fact that they live longer. So that's a huge redistribution. And in fact, what's the justification? Also, the fact that you force some people to finance their pensions, regardless of the fact if it is funded or non-funded, you make choices for them. So they, for example, cannot buy a new house or set up an enterprise because they don't have money, because all the surplus they would have goes to the pension system. So they can be trapped in a situation without. So maybe they can take a loan if they have a good investment project, or they can take a loan to buy a new house. But they wouldn't have to do it if they were not forced to pay this mandatory contribution. That's an argument. And another problem is that pension contributions are interpreted as taxes. That's a very important thing, and I want to focus a bit more on it. So here you have a line that describes two opposite situations. First one is private saving. So if you save 20% of your wage for future purposes voluntarily, your income, your net income, net of this savings, is of course smaller. But does it discourage you from working? Because the state, because you get less money to spend. And of course the answer is no, because you get the total wage and you voluntarily decide not to spend part of it. So if we have like 40 or 50% saving rate, that would not be bad. But 50% tax rate, that's bad. Yeah, because that discourages people from working. And so the opposition of private voluntary savings is taxes. So the amount of money that is taken from your salary, and that's not your money. You don't get anything. You get public goods, but you don't get them directly. If someone else finances them, that's of course very well for you. And I would argue that pension contributions lie somewhere between. So defined benefit pension contribution, which is totally not connected with your pension, it in fact works like a tax. Because some money is taken from your wage and you don't get anything from it. From your perspective, that's lost. But defined contribution, mandatory contribution, is not something that you lose. You cannot spend it now. You cannot spend it in the next, if you are young, 40 years, but still you will get something. Of course, it's not as secure as your private savings, but still it's something. It's not nothing. So it should not discourage you from working equally as taxes. And of course, the more trustworthy the pension system is, the less distorting the contribution is. So if a pension system is fragile, so if you see that the promises are too high and there will be some cuts, so in fact you don't know how much money you will get, that discourages you from paying. And I would argue that mandatory funded pension systems are less distortionate than unfunded ones, because you have more reasons to believe that you will get something from this money if the money is there, and if it's not just a promise from the government that can be changed at will. And in fact, from this follows the most compelling argument in favor of defined contributions. Because if the pension system doesn't serve it's not part of the wealth redistribution process. So people who earn more, they also pay higher contributions, and they will have higher pensions paid from. And these pensions can be paid by the state. They can be social security entitlements. It's still a better situation than a situation when we don't see any connections between the contribution and the pension. So so I mentioned these distortionary effects, and of course that has many positive externalities if the system works on the defined contribution basis. You have incentives to work longer. You have incentives to earn more, because the longer you work, the more you earn, the higher the pension will be. And also such system is more trustworthy because it's easier to balance it. You can easily incorporate some automatic balancing mechanism that will prevent the system from collapsing. And to a certain extent, Polish first pillar has such mechanisms. There are some flaws, minor flaws in that mechanism, but generally the idea, in my opinion, is works. So the system balances itself. Although we have a huge deficit now, but the deficit is a result of the old system. So the pensions that were promised in the communist times and early 90s, that they are higher than the long run possibilities to pay. So that's why the government subsidizes pension system. But that's a transitory process, although this transition will last like about 20 to 30 years more. So still, one might ask a question whether that it was a good idea to promise such high pensions, higher than the system can handle on its own. But we should distinguish that question from the whole question of long-term balancing of the system. And of course, still, if the system is unfunded, the state takes some demographic risk, because all the risk cannot. It's hard to transfer all the risk to pensioners. Okay, so in an unfunded pension system, pensions are paid from contributions of the working populations. So two questions arise. First, what happens when the value of pension is higher than the value of contributions? And of course, the answer is the government fills the gap. But if the situation reappears and if the gap grows, the government can go bankrupt. So the other question is how to prevent a situation from question A to repeat systematically. And the answer is to put some balancing mechanism inside the pension system. So usually, because you can balance the system in two ways. First, you can make the revenues rise, and another is to make the expenditure fall. And usually, countries decide to make the expenditure fall, because the high pension contributions are very distortive. That's I mentioned that it works closely to a tax on labor. But in some countries, like Germany, they have a long-term plan to raise pension contributions. And in my opinion, that's a bad idea, and that's a bad way to balance the system. But that's how they decided for now. But in most countries, also in Poland, the idea to balance the system is to lower the pensions in correspondence with the lowering or stagnating the income from the pension contributions. And the idea how such balancing mechanism can be made can come from the following equation. You have next year income from pension contributions, and that's a result of last year income times inflation times the increase or decrease in the number of workers times the growth rate of the real wage, real average wage. So in the normal times, when you have inflation is not that important. Let's say we have zero inflation. The number of workers is growing because we have a positive demographic trend. And because of the economic growth, you have also real wage growth. So usually in normal times, you get more money, you collect more money from mandatory pension contributions each year. But of course, the pace of growth is not is finite. So it's close to the real wage growth plus something or minus something if the number of workers is diminishing. So we can adjust pension promises to the pace of current pace of growth of the income from the pension contributions, and that's how the Polish system works. And so the promises are indexed by the wage fund, so total wage fund growth, one can say. And maybe it's easier to show the whole idea on the graph, so I'll move to the graph. So we can imagine a model where you have people who work 40 years and then they retire for 40 years. So they start to work at 20 and they live 100 years. Yes, for simplicity. And so first, the person was born in 1930, grew up, and then started to work and pay social security contributions. Of course, they are each year higher because of the economic growth. And then the person retired, and because that's an unfunded system, the state spent all the money here. So this money was not saved. This was not transformed into some asset. It was spent, wasted, if you wish. And then the person retires. And how we finance her consumption? And of course, the answer is we finance from the income of the people who are working, so the children of that person. So we assume that children are born after 20 years of working, and then they grew up another 20 years, and then they start to work, and they start to earn an average wage, and work for 40 years, and then retire. So here you have 3 examples of rules of promises formation, so promises of future pensions. So first rule is you get what you paid. So you see that these arrows, they correspond to some values of not yearly, but payment that took place in 10 years. And these arrows are identical. So you get the same money you paid. And you see that this promise can be met because your children earn more, and it's easy to pay what you paid, especially because in the beginning of the period you earned much less than they at the end of their period. So it's easy to meet such promise. Another, you get more generous rule, you get what you paid plus interest. Interest here means nominal GDP growth. So this pension contribution is indexed with nominal GDP and grows to the level of C4. That one also grows to the level of C4 because it's indexed with nominal GDP through 2 times, but the initial value is higher. So you get the identical 4 values and you get the same pension, which is higher than your contributions each year. And of course, if the income of your children is growing, they can meet the promises. even you can give your your parents even more generous pension. You can so the rule is called you get what you paid plus interest plus indexation. So the pension is inflation index, so or indexed in some other way. In Poland, we have inflation indexation plus 20% of the real wage growth. So it's pretty generous. And in the situation when the income of the children of these pensioners, they earn more, the promise can be fulfilled easily, even with indexation. But let's look at the situation when the number of people falls drastically and the income of these people also falls. So people who were working, they were earning less and less, and not per capita, but the whole population. And this time the rule "you get what you paid" cannot be met. There is such promise given on the basis of that rule. And also the indexation with nominal GDP, although it was negative, it's still too much. So you must also index the pension payments, actual payments to nominal GDP. And of course, you see that in theory, if you index it properly, that can balance. But in the real world, it's very hard to imagine a pension system that would not only adjust the promises, but also when the promises start to be realized, it would decrease the actual pensions. Because that means here you see that pensions are diminishing in accordance with the diminishing pension contributions. So usually, so the Polish pension system doesn't have an option to decrease actual pensions. So pension is calculated on the basis of your contributions plus interest. No, nominal GDP is a good proxy, and then you get the amount of money you paid indexed with inflation. And so it's not, so if the nominal growth of the income from pension contributions turns negative, the balance is broken and the system can go bankrupt. But such situation is highly improbable, that you will have many years of wage growth that is smaller than the in absolute values than the negative population growth. So even if the society is aging, it's not that you lose 2% of your labor force each year. You lose like half of percentage point, and the wage rate growth is like 1.5. So still, this income from pension contributions is growing. It's growing slowly, but enough to fulfill these pensions. So, in fact, we are much closer to this picture, although the growth is not as big as you see on the screen. It might be almost flat at some moment, but the real risk to our system would be if the income from pension contributions would start to diminish. How it can happen? If, suddenly 2 million Poles would live abroad and start paying pension contributions there, that would be a problem. but or suddenly if they start because of some epidemics or war or some other disasters, it's logically possible, but not that probable. But European pension systems, they don't have this. So they're in most of the cases they don't have any balancing mechanism. So they have some promises which are fixed and they won't be. They cannot be fulfilled. That must be adjusted on political or day-to-day political basis. In Poland, we have some rules in the law that adjust this automatically. Okay, how much time do I have? 10 minutes. Okay, so I will give few comments on the proposal of civic pension, and then we will end. So the popular idea is to give like 1,000 zlotys per pensioner, and to finance it from tax or some low pension contribution. And the benefit is that we lower total cost of pension, we lower mandatory contributions, so we lower the distortions on the labor market. And the idea is good, but there are, in my opinion, two important problems that make its realization hardly impossible. So the first problem is substantial transition cost. So if we don't simply resign from paying these current pensions, which in Poland are on average close to 2,000 zlotys per person. If we lower it by half, probably that would initiate powerful protest, social unrest. And I think no political party would decide to such a radical move. So usually part of this proposition is to keep paying the current pensions. But if you lower the contribution and you keep paying pensions, you end with a huge gap in the pension system that must be filled not only in 1 year, but in like 30 years. So how you can find money to fill that gap? You can raise other taxes, but other taxes are more distortive if you believe what I said, more distortive than pension contributions, because for taxes you don't get anything. For pension contributions you get promise of a pension. So in fact, the cheapest way to finance this transition is to still keep the pension contribution at the unchanged level. So in fact, not to make this reform at all. So, and also even if we manage this transition, still we have a problem with low pension contribution that is totally distortive, because it serves as a tax. We don't have any connection between the pension and the contribution. And so I also see it as less. It's much more egalitarian. So I would say that maybe that's a heresy, but from a libertarian perspective, the defined contribution pay-as-you-go system is better than a defined benefit, even if it operates on a low level. Well, maybe it depends on the level, but 1,000 zlotys per person is not a low level. Low level would be 100 zlotys. 1,000 zlotys per person, that's still billions of zlotys to pay. And it's not a small amount in that would be the biggest part of the public spending still. Okay, so from this I will finish. Maybe let's move to the questions. Okay.
Don't you know what is the amount of pension payments in Poland in average in total as a share of Poland's government expenditure? In Belarus, it is about 15%.
Oh, that's a lot of government expenditure.
Of government expenditures.
Okay, so if you have a calculator. Polish GDP, that's about 1,600 billion. Pension contributions, pension expenditure, that's about 140.
9%.
Yeah, 9% of the GDP, but percentage of public expenditure, we must take from Michał or from Mateusz the fraction of public expenditure as a percentage of GDP. In Poland, that's I think 54%.
About 40.
No, expenditure, public sector expenditures, no, much more. That's it depends, because in 2010 it was about 60%, because we had a huge deficit and big expansion, fiscal expansion connected with projects financed with partly with European funds, like this hotel. You know, if you've seen the label that it was financed by the European Union. Okay, and other questions? Yeah?
Yeah, if you have to make a compromise with the libertarian theory, which there always is if you have a compulsion on pension schemes, then I think this system is better than defined contribution, as you said, because there you introduce incentives to forcibly save more and redistribute more, and that's how it ended up in Slovakia, for example. So it's always better to keep a lower level of overall expenditures and forced contribution.
Yeah, but you can imagine a situation when some politicians would advocate for increase in this minimal civic pension. And that might be a very popular policy. And if you increase some entitlement to the majority for which the minority pays, that can be politically very attractive.
But it's a different argument. That's not choice.
So this civic pension, I would predict that it would grow. It would not be low. And the situation when you have a stable fraction of your income transferred to a pay-as-you-go system, but without any, because a Polish pension system is, except for the minimum pension, it's not redistributive. So you get what you paid plus interest, which means nominal GDP growth. So it's not that poorer people who earn less, they get higher pensions. So it's much less egalitarian.
Yeah, there are the problems with this point of view. First, you have a big group of people who are in this cruise system, and it is redistributive. And second, there is going to be a big group of people who do not give enough to the system to take this smallest pension. So it will be redistributive for a big group of people. This is an argument of Mr. Gwiazdowski, that it is politically unacceptable to have so small pensions as we should count from this system for people who are on the civic contracts.
Yeah, but if you ask about my policy proposal, I would first make this system really common for everyone. So liquidate the special pension privileges, and then try to impose the contribution on every type of arrangement. Then it would, because now many people might avoid paying contributions at all. So we have this free riding problem. They work, they either pay minimum wages, paid minimum wage, and then they earn the rest of the money. That was an interesting experience when I was. So I took a hitchhiker, a truck driver, and I asked him, "How much do you earn as a truck driver?" And he said, 5,500 zlotys per month. And I said, so you pay a huge contribution, so you should advocate against the government pension reform. And he said, no, I pay very small contribution because officially I get only 1,600 minimum wage, and the rest I get in cash. So that's a very unfair situation.
And this is why it can't work.
Yeah, but the reason is why it doesn't
getting bigger and bigger.
Yeah, but
that only shows that people opt out of the system, and they are not interested in defining.
Yeah, but is it a rational behavior?
It's rational.
It's rational because it's human.
They have hundreds of other options how to accumulate wealth to provide for.
But most of them won't use this option. They will end poor and elderly. Yeah.
They have high time preferences, so you cannot.
And then they will force on us, on those prudent. I hope all in the room are prudent. When
No pesos. Not even 1 zloty.
Yeah,
I can tell you how.
Sorry.
And you have also this problem with small entrepreneurs who pay big tax or big, I don't know how you call it.
pension contribution.
Yes, pension contribution, and they will take small pension, and they feel that it is unacceptable for them. It's unjust.
Yeah, but I agree that that's a theory. In practice, most of the people treat pension contribution as tax. But I argued that they shouldn't. Because that's not the same. You get something for pension contribution, you get nothing for paying taxes.
But you don't know in 40 years' time how many times the government will change the rules of the game. So it's de facto tax.
No, but the expected value of payment from taxes is zero. And an expected value from pension contribution is non-negative.
Practically zero. Look at Poland 40 years ago. And you have no idea that false communism will come, that the system will constantly change.
Okay, but did the system change in the United States 40 years ago or 80 years ago? You still have market economies, more or less stable rules, but they have much worse pension system than we do, I would argue. Yeah?
Do you see a conceptual difference between a pay-as-you-go pension plan and a Ponzi scheme, for example?
In a Ponzi scheme, you are promised positive rates of return, higher than the market rates. And here you get lower rates of return than the market rates of return. So if you invest your money in a portfolio of assets, bonds and stocks, you'll get more than paying ZUS. But although I don't know if you know the fact that many people believe that investing in their money just on a bank deposit would give them more than the indexation in the Polish pension security scheme, and that's false. So the interest rate on deposits were smaller than the indexation in the pension scheme.
Over which time frame?
Since the beginning, 1999, 2012.
Yes, but that's just down to a specific time period, right? Because let's take US in the 80s, and then that's interest rate of 60%, so that's what we would earn.
Yeah, but the nominal GDP was growing even faster. We can check that. Of course, the perspectives in front of the Polish pension security system are worse in the future than they were 10 years ago. Because in 2012, the number of people in the labor force peaked. Now it will diminish for the next 100 years or more. So, the indexation will not be as favorable as it was. So it's so the gap between the funded returns of the funded part and if it will be in place and the unfunded will grow. Yeah?
What's your opinion about Chilean solution to two solutions? Chilean solution of pension problem and the solution advocated by libertarians of eliminating all government pension debt.
No, I would oppose eliminating all government pension debt. That's socially unacceptable.
Because of political reasons or because of your beliefs?
No, because they don't have any. They participated in the system and they don't have any other. Many of them don't have any other sources of income. I would accept some corrections, so some reforms that would aim at decreasing of pensions, but not abolishing them at all, totally. That would be a disaster, social disaster.
Yes, pension fund deficit is about, according to 2008 statistics, about $100 trillion. So it's a matter of, it's a question of time when the system will collapse.
It's not a deficit, it's the it's total sum of future payment, but the total sum of future income. There's a nice
between expenditures and revenues.
There's a paper by the Cato Institute.
There's a book by Kotlikov and Burns, pension system before crash.
Okay, I don't know the book. Quite recent paper by the Cato Institute on the future situation of public finances in the United States. It's not that dire. It's not that they will go bankrupt. They will have to make some adjustments, but it's not that it's impossible to adjust. The gap is so large. And what was the other question? Yeah. Okay, sorry, the time is up. Thank you.
Thank you.